Hey traders, welcome to Charts and Coffee. Today is Jackson Hole Friday. So remember, the Jackson Hole Symposium began yesterday, and we did get a little bit of sporadic chatter from some of the FOMC members. But the only guy who matters, the only one that actually is truly allowed to speak on behalf of the Federal Reserve is the chairman, right? Everyone else can talk their opinion, right? But the Powell is the mouthpiece. He is the guy. 10:05 today Eastern. So the bell's going to ring. We have 35 minutes. Boom, he's going to hit the mic. Ultimately, what we want to remember, and we'll do this when we start off the session in the room, but let me show you here really quickly how we want to measure Powell. So I'm going to take y'all over to the CME FedWatch tool. This is the website from the Chicago Mercantile Exchange that tracks the Fed fund futures. What that means is these futures contracts where traders can quite literally place their bets on whether or not they expect the Federal Reserve to hike, to cut, to pause, whatever, right? We're still arguably at the very, very, very end of a tightening cycle. Could we get another quarter point hike? Absolutely. But what is most important is, are we expecting a hike or not? Are we expecting a pause or not? What's been, as we say, discounted? What is baked into that cake? So for September, take a peek. 80% expectation of a pause. Once we hit this magical 80 level, I will tell you, this usually for me translates into that whole saying of fully discounted. Now, look, I can never account for what every trader and investor has priced into their portfolio and their positions. However, once we hit about 80, believe me, within the hallowed halls of the Federal Reserve, they know that traders are expecting a pause, which means if they were to hike, they are upending expectations. They really don't want to do that. So Fed fund futures are as much a communication device as they are a futures contract, meaning via Fed fund futures, traders are telling the Federal Reserve, this is what we're expecting. And if you do anything other than that, there is going to be a consequence. And believe me, the Federal Reserve really doesn't want to do that. Go out to November. This is where it gets far more interesting. And again, could we see another quarter point hike? Absolutely. This is the pause, right? Or hold, however you want to look at it. This is the quarter point hike, 41% versus 51%. This is plus or minus 10%. This is going to move. This is going to move with Powell. Now, over here, that's 7.1%, which you'll always hear the talking heads on television. Mute them, for crying out loud. But what they'll say is, oh, we could see a half point hike. What they oftentimes neglect to say is, yeah, it's coming in at a lowly 7.1. So really what's happening is, are we going to see a pause or a quarter point hike? Now, the Federal Reserve does not know what they want to do in November, right? Because we still have non-farm payroll, weekly initial claims, PCE, CPI, ISMs, GDP. We still have those to come, but they are going to keep the door open. And we know this. We as traders and investors know this. Hence, this is as prominent a column as it is. Is this a shock? No. What would be a shock? This would be a shock to the system because of how minimally it's expected. So again, this is so easy to decode. Use the magic decoder ring, use these target rate probabilities from the CME. This is what we're expecting. Now, some traders, they want to talk about what's going to happen in the future. Some traders want to say, well, this is what they're going to do because it doesn't matter what I think or feel or whatever my gut says. This is the data, right? The more that we're anchored in the reality of what's discounted and expected, the more we can trade the reality of what's happening right now, right? So I've been hearing, oh, the Fed has to hike, the Fed has, doesn't matter. It depends on what we're expecting and how they respond in these corresponding meeting months based on what we've already baked into the cake. So by the way, a quarter point hike, is that going to upend the equity markets? No, because collectively, we only think there's 10% less a shot that we do get it than we don't. So it's almost neck and neck. This is not a surprise, right? This will not be a surprise. Clearly we'll sell off a little bit because look, stonks hate higher rates. However, it's not going to be a shock to the system. This is not Jackson Hole 2022, gang, not even remotely close. All right, so with that being said, that's the data. That's what we want to rely on. So let's jump into the questions and charts as always. Thank you so much for being a part of Charts and Coffee. Let's get to the caffeinating and dominating. Good morning, good morning, good morning. All right, so let's see what we have here. First up, what's going on in China? With what's going on in China, hey there, mind the gap. With what's going on in China and better than expected supply to the market, do I still see a rebound in crude? Okay, so look, crude oil has a central bank, if you want to think of it that way. Just as the European Central Bank and the Federal Reserve and the Bank of England and Bank of Japan, Swiss National Bank, etc., they control the monetary policy, meaning interest rates, and also the flow of currency in terms of printing or not. OPEC is kind of that, right? Think about it. They're controlling the flow of production. So I look to OPEC as the main determining factor, mind the gap, for what it is I would expect crude to do next. I'll sometimes look at things like traffic patterns, especially when we were coming out of the pandemic. I'll look at things like EIA and IEA numbers, the different governing bodies around energy. I'll look at what they're saying is expected demand versus supply. I'll also look at the underlying structure because remember, no matter what kind of research I do, it doesn't mean that the research that we have found individually is what's moving the broader markets. And that's oftentimes a bias that most traders have. Well, meaning Raghee, I know this. Therefore, that's how I will trade. Remember, the market might have already discounted that sometimes weeks in advance, or the market may not care, right? So I never want to get caught up in, well, this is what I think, and this is this little nugget of data that I have. That's actually going to get us in trouble in trading, and I see that quite often, actually. What I do is I say to myself, traders who are moving far more, look, if I'm trading crude oil and I get into maybe 6 to 8 contracts, maybe 10 contracts in crude, that's going to be pretty well positioned for me. There are traders moving hundreds, if not thousands of contracts, or there are, brokerages or different groups that are moving a lot more size. Remember, gang, we're not the biggest and we don't pretend to be. What we want to ask ourselves is, what is the collective market doing? Is it bullish or bearish? Where is it stopping? Where's the volume? So there's 2 ways I'll look at this. Mind the gap. I'll look at the 200, the dots here on this chart. That's the 200 exponential. Are we above that? I'll look at the gray zone on this chart. Are we trading within normal volatility parameters? Absolutely. And the last thing I'll look at are different price-based volume ledges, possibly an anchored volume-weighted average price. Because if I really want to know what size is doing, open, high, low, close is never going to be a path to that. If we want to know what size is doing, where the quote unquote big money is, that, my friends, is volume. So I will take a look at some volume levels. But yes, I'm going to continue to look for an upside as long as we can stay above the 200, as long as I can see support from the daily price movement range. And take a look. We were in an uptrend for about 3 weeks. We're oversold now, and we're in a choppy environment. So absolutely, that would be the building blocks of a setup to the long side. Yeah. All right. Tesla. Hey there, green eggs and ham. Pullback buy. So how would I do a pullback buy on Tesla? So first of all, if I'm looking for a quote unquote pullback, I'll use that terminology specifically within the context of a trend. On the daily, I haven't had a trend since July the 26th. So at the very end of July, that uptrend that we enjoyed, gone. No problem. What are we above? It was very important, gang, that we put this minor low pattern in. You can see that right there. That was actually really pretty bullish. So when price broke the 200, rather than accelerating down through that, it came right back up and established price action once again above that level. That's huge. What's the other thing I can see that's working pretty darn well? Well, once I have an oversold stochastic in a neutral environment, I'd like to, especially above the 200, right? I'd like to buy different levels. But I'll tell you what, Tesla, of all the stocks I could look at, green eggs and ham, I'll be frank, Tesla, because it's choppy on the daily, I would just as well say, hey, go on the 1 hour time frame, put on shorter term swing trades because there are trends in tech names. There are trends in other corners of the market, different sectors that have trends or have trends that haven't been broken for as long. So if I'm looking for a pullback by a mean reversion, a retracement, there are other places I will look. But if I've had a prolonged period of sideways action, why not just dial it down to the 1 hour? And that time frame selection, that ability to say, oh, by looking at my different gauges, daily versus 1 hour, which one do I want to take? Those are the kind of things that I teach, and they become very sequential. We know that because of this item, that item, that item, or these different characteristics, it's time to think about a different time frame for the setup. Not that we are necessarily going to trade Tesla, but at least I know what time frame I have a better edge on. So that's kind of the way I look at that there. And so I hope that makes sense. By the way, speaking of making sense and speaking of different time frames and how to choose which time frame, I know that's oftentimes a really tough decision. I mean, we're having to pick the time of day, we're having to pick the symbols we're trading, and on top of that, we're having to pick time frames. So one of the things that I've done over the past, it's been about 10 years now, is I've given a single time frame a single job. So I'm never in a situation where I'm looking at Amazon and saying, oh, do I trade the 5 or the 1 hour or the 4 hour or the daily or the weekly or the 20-minute or whatever. Each time frame has a job, and I've chosen 3 of them. Probably the one that's the most important right now in my life and in terms of controlling risk in an environment of a lot of macroeconomic murkiness is this time frame, the 5-minute. The 5-minute allows me to look at about 3 different windows of opportunity. So I'm not sitting behind my desk all day long looking for opportunity. And in those 3 different windows, I can dial the time frame down to a 5-minute. The 5-minute time frame's job is a day trading. Think of it this way. If I'm day trading between 9:30 and 4, I need traders to find a directional bias, or at least price, to find directional bias, form a setup, trigger the setup, and give us follow through, all before we close. I need those 4 things, right? Every single day. If it's too long a time frame, all those things don't have time to percolate and finally, yield some sort of entry. If they're too short, I end up with a really twitchy setup. Things look like they're going to set up and follow through, and then all of a sudden they just move against me because I'm looking at a time frame that really didn't have some solid psychology behind it. That's why I like the 5. A lot of folks ask, Rog, why not a tick chart? Why not a 1 minute? For me, too twitchy. I want a time frame that, for example, could trigger a buy in the morning and follow through to lunchtime. Maybe even past that, where I could possibly get out at 3:50 p.m. Eastern, 10 minutes before the bell rings. If it's too short a time frame, there's no way I can keep on that path. If it's too long a time frame, my trigger is going to happen so late in the morning that I need an immense amount of follow through just to make some profit on that option. So these are decisions that I think a lot of traders don't necessarily know what to do, and they just figure, well, if I'm day trading, I go to a short-term time frame. On Wednesday, if you haven't already checked it out, on Wednesday, next Wednesday, I'm looking at my calendar here, the 30th, we're going to have a webinar. And in that webinar, you think I do a lot of discussion and explaining in charts and coffee? Wait till you get to the webinar. simplertrading.com/consistent. You, me, 8 p.m. It'd be cool if we could have dinner. Wouldn't that be cool to have webinar and dinner? That'd be kind of fun. Anyway, we're going to get together. We're going to talk about what the day trading is doing in this month. Yeah, we can talk about July, but let's be frank, gang. July was a seasonally bullish month, and it went straight up. Anyone can make straight up money in a market that's going straight up. Who cares what I did in July? Although I'm happy to share that with you. What's tricky is, can you make trades and manage risk in August? Can we do it in September? Have you all taken a look at the September seasonals? They sure as heck don't look like July. So whatever you're doing, if it's kind of fitted to, oh, here's what I did in July, who cares? Because August, September, October, November, they're going to look a lot more like August, but with more volume because we'll be into the fall trading season. So why does that matter? This is why. If we still have question marks about what the Federal Reserve is going to do, if we generally have question marks about, what monetary policy, money printing, and yields are doing, we're going to have to shorten the time frame. Is it what I always want to do? No, but we need that gear to be able to shift into. So we'll be talking a lot more about that on Wednesday, next Wednesday. So simplertrading.com/ I think I gave you all the wrong link yesterday. Consistent, not consistency, consistent. All right. Next up, what do we have here? Let's keep the questions going. All right, rainy day. Oh, sorry. Tech Trader Joe. Sure. Can I explain where I anchor for the VWAP? Yeah, actually, Tech Trader Joe, I'll get into that in a whole lot more detail on Wednesday, but I actually like to anchor based on the window that I'm trading. So if I'm trading pre-market, it's usually 3 VWAPs. If I'm trading pre-market, it's going to be a different 3 anchors. If I'm trading the US Open, it's going to be a different 3 anchors. If I'm trading the afternoon session in that window that I really like, it's going to be a different 3 anchors. So we'll touch base on that. But for example, right now, I'm going to have an anchor primarily at 9:30, right? That's going to be a very important anchor. I would also check 7 a.m. Eastern as well. All right, rainy days. I'm looking at XLF. All right, let's jump on over there. I'm looking at XLF out to September. All right, so this is going to be a daily time frame. Sure, let's take a peek. All right, so XLF has seen better days. In fact, most of our really good trading in the Sector Secrets Mastery around XLF was basically the beginning of July to the beginning of August. And then come August, we started to test the 200 propulsion, the white dots. We started to move into more of a sideways chop. So right now, I don't have something on XLF, rainy days, that I love, to be quite frank. I'm probably going to have to scan the individual stocks within the XLF until I find a setup that I really like. JP Morgan might be something to watch. Looking at Citi, Morgan. Yeah, JP Morgan or XLF might be the way to go, but I don't have a setup as of yet. Would I be bullish? Oh, absolutely. Absolutely. We have a trigger confirmed, actually, as of yesterday, on the 24th. On the 24th, we actually completed within the allotted time the minor low. See that little arrow right there? That's our signal of the setup. So we like to signal before the trigger, not after. I don't want anyone having to chase after something that already fired off. So the kind of signals that I use, that little arrow right there says heads up. When this happened, it's 2 things that I'm looking for. When this and this happen, we can buy. And so actually yesterday would have completed the pattern. The only thing that I don't like, quite frankly, about this, the only thing I don't like is the fact that it's happening just below, sadly, the 200. Not terrible, but not ideal. A move into the daily price movement range, this gray area, would be perfect. Would be absolutely perfect. All right. So cool. So that's it. That's it, gang. That's a wrap. So if you haven't already registered, if you're looking for more detail, we're going to be having a webinar. I didn't know if we were going to have a day trading webinar as we wrap up the year. I already had my swing trading webinar in class back early this year. And what's happening right now, gang, is swing trading is still great. However, it's less frequent. And so the problem that I have, and a lot of traders have, is we got to keep our pipelines full of opportunity. And if one style can't keep the pipeline full of opportunity, let's face it, we got to make the money to keep the lights on. If I don't have enough trades to keep myself busy, one of 2 things happen. We force trades, which is a terrible idea, right? Or we say to ourselves, well, what style is working right now? And that's what we're going to talk about on Wednesday. What am I doing right now to sort of fill the void between the sort of infrequency of the swings? They're still solid, but they're not as frequent as I need them to be, right? So we'll talk about that, keeping your pipeline full, and how day trading right now is going to allow us, frankly, to control risk. Right? Anyone who's been following me knows, number 1, control risk. Because I could say over 30 years, I've never had a negative year, which is true, right? But more importantly, I've never blown up an account. So if we can think about how do we adjust to make both those realities true for everybody as best I can, we're going to talk about how day trading absolutely has a job in that goal. All right, gang, I'll see you all on Sunday for Top Tier Outlook Live. My Sector Secrets Mastery folks, I'll see you in just a few moments. Thank you as always, gang. Caffeinate and dominate. Jackson Hole, big day 2, 10:05. Kapowell, gang. Heads up. It's a caution day. I'll talk with you soon.